This time, in this video, we are looking at fiscal and monetary policy. So first of all, let's look at fiscal policy. As fiscal policy is the way in which the government adjusts its spending levels and tax rates to monitor and influence a nation's economy. Now this stems from the idea that the government can influence the economy and keep inflation at around 2% by increasing or decreasing tax levels and public spending. Now the idea of this is to find a balance between tax rates and public spending. For example, by decreasing tax rates or increasing public spending, there will be an increase in the amount of money in the economy, and that can result in the decrease in the value of money and high rates of inflation. At the same time, a decrease in tax rates and an increase in public spending is often necessary to improve a stagnant economy with high levels of unemployment. At the same time, when inflation is too strong, the economy may need a slowdown, and in this situation, the government will use fiscal policy to increase taxes in order to suck money out of the economy. Now, the negative effects of this are a sluggish economy and high levels of unemployment. Now, the effects of fiscal policy will affect people in different ways. For example, tax increases may affect a certain class more severely, and an increase of public spending may benefit a certain area rather than the entire country. Now, the stock market will also react to fiscal policy, and they will often rise after an increase in public spending designed to reignite the economy. But now let's look onto monetary policy, as monetary policy is a policy adopted by the monetary authority of a country that controls things like the interest rate. So in the UK, it's the Bank of England, which is the central bank, and in the US, it's the US Federal Reserve System. Now, the two main monetary policy tools that are used include changing the interest rate, which is known as the bank rate, and creating money digitally to buy corporate and government bonds. Now, this is known as asset purchase or quantitative easing. For example, if a country is facing a high unemployment rate during a recession, the monetary authority can opt for an expansionary policy aimed at increasing economic growth. So this includes lowering the interest rates, which makes money saving relatively unfavourable and promotes spending. It also means that businesses and individuals can take out loans on more convenient terms to spend on consumer goods. On the other hand, increased money supply can lead to higher inflation, and therefore contractionary monetary policy can be used to raise interest rates and slow the growth of money supply. Quantitative easing is also used in addition to lowering interest rates because there is a limit on how low interest rates can go. Quantitative easing involves creating digital money and buying things like government debt in the form of bonds. Now, a government bond is issued by a national government with a promise to repay the face value on its maturity date, as well as periodic interest payments. Now, the aim of this is to support government spending. Now, large-scale purchases of these bonds will lower the interest rate, and this has the subsequent effect of pushing down the interest rates offered on loans. Now, quantitative easing can also stimulate the economy by boosting a range of financial asset prices. For example, if the Bank of England bought £2 million of government bonds from a pension fund, the pension fund might invest this money into financial assets. Now, this will consequently increase the demand for financial assets, and the value will therefore increase. Now, this will subsequently boost economic activity. So thanks for watching. If you click on my website link in the description, there is a link which will give you a free share of up to £100 if you follow the instructions. But thanks for watching and see you soon. Bye.